Hi, my name is Daniel Yergan. I'm a financial planner at Valmark Financial Group, and today we're going to be talking about Roth conversions and factors to consider before completing one. Now, the first step to making a Roth conversion is making a contribution, whether that's to an IRA or an employer plan, and that can also be deductible or non-deductible based off of your income for the year. You're then going to want to convert the retirement account, whether that's converting from an IRA to a Roth IRA or converting from a 401k to a Roth 401k. If you are converting an IRA, you're also going to want to be aware of the Pro-Rata Rule and the IRA aggregation rule, which says that you cannot choose what deductible or non-deductible funds you want to convert. All of those funds will be converted on a pro rata basis, as well as the aggregation rule, which states that all of your IRAs are considered one, whether that's traditional, SEP, or simple IRAs. You're then going to pay the income tax on the taxable amount of the conversion, which are going to be those deductible dollars. You can also have a 10% penalty exception, meaning that you can pay the tax on the conversion from those traditional assets if you have reached age 59 and a half. And if you haven't met a penalty exception, you could always use non-qualified assets or cash to pay the tax on those conversions. Next, you're going to want to satisfy the 5-year rule on conversions. Now, every Roth conversion has its own 5-year rule. So if you do multiple conversions, you will be opening up multiple 5-year windows that have to be satisfied. You can also bypass this 5-year rule on conversions if you meet a 10% penalty exception, which is namely reaching age 59 and a half. And lastly, you can then withdraw the conversion tax-free. However, before withdrawing it tax-free, we have to talk about Roth ordering rules, which state first, contributions to a Roth IRA come out, and then the older conversions come out, then the newer conversions come out, and then the earnings. Let's talk for a second about the taxation of those four. So contributions always come out tax-free, penalty-free, anytime, no questions asked. As it relates to conversions, you always start with your older conversions, then work through your newer conversions. The conversions are always going to be tax-free because you already paid the tax when you made the conversion. Regarding the penalty, you're going to want to do one of two things. You're going to want to either satisfy the 5-year rule on that conversion or meet an exception to the 10% early withdrawal penalty. Most people do that by satisfying the age 59 and a half exception. Very lastly, you can withdraw the earnings on those contributions, which, as opposed to satisfying either one of two rules, you're actually going to have to satisfy two rules. Both the 5-year rule on contributions, which is separate than the 5-year rule on conversions, and also meet an exception to the 10% early withdrawal penalty. Again, most people hit the exception of reaching age 59 and a half. So now that we talked about the mechanics and the steps of completing a conversion, let's talk about factors that make conversions more appealing. So this first factor is federal and state income tax. And taxes are one of the biggest factors to consider because we're going to want to say, do I want to make a conversion if I'm in a very high tax bracket right now and I'm going to be in a lower tax bracket in the future? Probably not. Ideally, you're going to want to make the conversion when you're in a lower tax right now to take advantage of those lower rates and then withdraw the conversion tax-free later on when you would otherwise be in higher tax rates. And not only federal income tax, but also state income tax is another factor to consider. Why would I make a conversion in the state of California that has very high state income tax if I know that I'm going to retire in Florida and I have no state income tax when I make that withdrawal anyways? You're also going to want to consider the filing status, whether you're married filing jointly or single, because both of those filing statuses have different marginal brackets that you're going to want to utilize when determining how much should I convert when I'm trying to max out a certain bracket, whether that be the 10%, the 12%, or the 22% bracket. And very lastly, regarding the beneficiaries of these accounts, does it make sense for the owner to pay the tax when they're making the conversion, or does it make sense to not do the conversion, allow the beneficiary to inherit it, and then allow the beneficiary to inherit the funds? The second factor to consider are required minimum distributions, which one of the main benefits of completing a conversion is that all of the growth on those conversions will never be required to be withdrawn, at least during your own life. So you're able to escape RMDs on any money that you do convert. That's not the case if you do an in-plan Roth conversion in an employer plan, but you could always roll out the assets from the plan to an IRA to avoid RMDs on that. So one of the main reasons you want to avoid RMDs is because required minimum distributions can increase your income to such an extent that you're now facing what's referred to as stealth taxes. A few stealth taxes that are common for retirees would be IRMA, which are your Part B and your Part D Medicare premiums, also the net investment income tax, as well as the Social Security tax torpedo, which includes more Social Security in your taxable income for the more income that you have. Lastly, RMDs could increase your income so greatly that you're now phased out of certain deductions or credits that you could have otherwise claimed before the RMDs began. All of these are great reasons to do conversions, to decrease those qualified balances, to decrease your RMDs to avoid these stealth taxes. A few other miscellaneous considerations would be estate tax exemptions. So a $1 million traditional IRA might be the equivalent of an $800,000 Roth IRA. So Roth conversions allow us to reduce our taxable estate. Now, recharacterizations on conversions were actually repealed, so we cannot do a conversion and say, never mind, I think I want to go back and redo that. So it's important to know, when I make the conversion, am I locking in favorable market rates, or is the market going to drop? That makes, when the market does drop, a nice favorable opportunity to do Roth conversions. You also need to be aware that RMDs come out first, so if you've already reached your required beginning date, you cannot do Roth conversions until you've already satisfied your RMDs, making conversions really attractive for people that have not yet started their required minimum distributions. There's also the IRA Pro-Rata Rule and the IRA Aggregation Rule to consider before doing conversions, and the 5-year rule on conversions, both of which I've already spoken about. And lastly, the possibility that Roth conversions might be eliminated, which we did see in the Build Back Better Act, which is eventually repealed. But nonetheless, we've seen signs that Congress may be targeting some of the benefits that come with Roth IRAs and might seek to further repeal Roth conversions, making now a great time to consider them while they're still in play. So I hope you learn a lot about the rules of Roth conversions, the steps on how to do one, and factors to consider before completing one. Thank you so much.